We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome into Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning. You can always learn more on the website. That is deckerretirementplanning.com. Find out about Brian, Mark, and the team. A lot of great information on the website. You can find out about upcoming events. You can find out where the offices are. There's a lot of opportunities for you to attend an event, but you also have some great information on the website. So check it out, deckerretirementplanning.com. There's also, under the heading of Safer Retirement Education on that website, there are 12 different things you can download, including Brian's book on retirement, the Decker Approach book, and it's all there just for your information. You get it, you grab it, you download it, all of it, whatever, it's whatever you want. And then you may have questions, you call them, 833-707-3030, 833-707-3030. I'm Mark Elliott. Glad you're with us. Brian J. and Marc Knauss are going to get after a little bit of taxes today, Brian, it sounds like.
That's right. We're going to talk first off how tax inefficient the IRA is as a tax deferred vehicle. And on the one hand, it sounds fantastic, Marc Knauss, that we've got tax deferral. You can put money away in your 401k and you fatten the pig for the slaughter, but you're also fattening the government's part for the slaughter too.
Yeah, exactly. So I often look at the pre-tax accounts and I think of it almost like a loan that you owe the government later on in life. So when you put money into your pre-tax account, the government says, good job, Brian. I'm very proud of you for saving for retirement. In order to incentivize you, I'm going to give you a deduction on this year's income taxes. Well, fast forward 10, 20, 30 years, and now all of a sudden that IRA has grown to maybe 3 or 4 times what you originally put in, and now the loan balance is due. And when you start taking money out of that IRA, the government says, okay, you've deferred long enough. Now you got to pay the piper. And the interest rate on that loan that the government gave you was essentially the growth rate of the account itself. So if that account has been growing at, let's say, an average of 8 or 10% or 20% a year, then all of that growth, that compounded growth, is income taxable to you in retirement. So you just got to be aware of the taxes that are due in the future when you have these pre-tax accounts that you're putting gobs of money into with your 401k or your pension or your defined benefit plan, whatever it is that you're stocking money away into for retirement.
So let's put some numbers into how horrible the IRA is as a tax vehicle. So here's a 60-year-old with $1 million IRA growing at 6% a year. At age 73 or 74, depends, they start paying their required minimum distributions. And then at age 90, we killed him off. So how much taxes did he pay? Well, in his life, he paid $676,732. But wait, there's more. The Secure Act requires that beneficiaries who receive IRAs have 10 years to pay the rest of the taxes. That's another $718,496 for a total of $1,395,228. Almost $1.4 million goes to the IRS. In 30 years of the IRA growing at 6% a year, beneficiaries get 1.2. The IRS wins and gets 1.4. Mark, take it from here. There's got to be a better way to do this.
Well, I mean, you mentioned it, and there's a few real important considerations. When you start taking money out of that IRA, number one, you've deferred, and you're seeing all that growth, but all that growth is going to be taxable in the future. So working with a financial advisor, laying out an income plan allows you to develop strategies around Roth conversions and how you can minimize your overall taxes that you pay from your retirement account. When you do Roth conversions, you take IRA dollars and you convert them over from a pre-tax account into a tax-free account. Now, when you do that, you're going to pay taxes on the front end. So that's your cost. But the growth in that Roth IRA is 100% tax-free for the rest of your life. You never have to pay tax on those dollars again. So if in the scenario that Brian laid out, this 60-year-old client with $1 million IRA growing at 6% a year for the next 30 years of her life, I mean, you're paying over $1 million in taxes. But if you convert to a Roth on the front end, you do the heavy lifting, you pay the taxes early on and get Uncle Sam out of the picture today, then that gives your account decades to grow tax-free. And the tax savings are incredibly powerful. So let's say, for example, this client does some heavy Roth conversions in the early years. 60 years old, 61, 62, 63, you pay the higher taxes today, but it grows tax-free for the rest of her life. You're looking at total taxes paid. Get this, write this down if you're by a piece of paper. Total taxes, $319,000 compared to $1.4 million in taxes if she doesn't do the Roth conversion. Total benefit to the heirs. In the event she does the Roth conversion, she's passing $4.15 million on to the children, as opposed to $1.2 million passed on to the kids if she leaves all the money inside a pre-tax account. The tax savings of a Roth conversion strategy are incredibly powerful, but you have to do it the right way. You have to do it strategically and with intentionality and planning with a purpose over a long retirement plan. So that's where we come into play, is we help all of our clients with the Roth conversion strategy because we know it can be so powerful if done correctly.
So that account, with a Roth account, it grows tax-free, distributes income back to you tax-free, passes to beneficiaries tax-free. What we're not talking about is contributions. Many of the people who are in their later years and the peak of their careers, they're not qualified, they're not able to contribute to their Roth accounts. What we're talking about is conversions. So, Mark, I like the analogy of the farmer. If you have a choice of being taxed on the weight of the corn seed or the yield, which would you choose? So if you choose to be taxed on the weight of the seed and you have all of that growth being non-taxable, that analogy illustrates how a Roth works. What else would you say on the Roth before we move on, Mark?
You know, a few things that often people don't really consider when they're thinking about the pre-tax. Number one, they often think, and you hear this all the time, that people will say, when I'm in retirement, my tax bracket's going to go down. But so often that is not the case at all. In fact, what I've seen is quite the opposite. Sometimes people's tax brackets go up because they no longer have 401ks that they're able to contribute to in retirement. They no longer have the kids at home that are tax deductions. So they run out of a lot of tax deductions and itemized deductions. So their tax brackets will go up in retirement oftentimes. And when you take distributions out of a pre-tax account, that has a significant impact on your Medicare premiums. So the Roth conversions not only save you on required minimum distributions, but they also can save you on your Medicare premiums. So you want to take into consideration all of the expenses as it relates to distributions from a pre-tax account.
And Mark, a couple more things before we move on. What's the right and wrong way to do Roth conversions? You wouldn't do a Roth conversion for an account that you're going to completely empty in the next 3 or 4 years, or would you would never do a Roth conversion in an account where the growth rate is lower. So talk about what kind of accounts you would target and also the right way to do the calculations.
Yeah, a core principle when you're talking about Roth conversions is, remember I mentioned you have to pay the taxes up front. So let's say you do a Roth conversion and it pushes you up into the 22 or 24% tax bracket. Well, that's your bogey. That's what you have to grow past in the Roth IRA in order for the Roth conversion to make sense. So, Brian, when you mentioned this, our core philosophy with Roth conversions is we want the Roth dollars growing for as long as possible in the highest growth rate possible. So you're right, we don't want to do a Roth conversion and put those dollars into a money market. We don't want to do a Roth conversion and put those dollars into bond funds. We don't want to do a Roth conversion and put those dollars into a CD. The growth rates on those strategies are way too low, and you don't end up making up for the taxes that you paid on the conversion. So when you do a Roth conversion, that is now your bucket for long-term aggressive growth. And that goes towards the back of your plan, growing for 15, 20 years. So all of that growth is tax-free.
So if you'd like to talk with the team at Decker Retirement Planning about Roth conversions, and remember, the big, beautiful bill extended the tax rates and brackets. It says permanent, but we know another administration or Congress could certainly whack out the permanent part. But we know we've got them now for 4 or 5 years. So you do have a really nice window to look at some of these Roth conversions. Do they make sense? Do they not? 833-707-3030 is the number. 833-707-3030. You got questions, you got concerns. Talk with Brian, Mark, and the team at Decker Retirement. There's no cost to you. 833-707-3030. We're just getting started on Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning. We got a lot to get to. Stay with us. Back with more right after this.
Is the price tag on everything giving you sticker shock? From groceries to gas, the cost of living is skyrocketing. But if you think inflation is painful now, just wait till you retire. Ease inflation's impact on your retirement dreams by calling Brian and start preparing today. 833-707-3030. Again, that's 833-707-3030.
Uncle Sam might need a loan soon from you. We have over $35 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio. I'm Mark Elliott alongside Brian J. Decker and Marc Knauss of Decker Retirement Planning. You can always call them if you have questions. Boy, can we retire? Well, when? Do we have enough? Are we going to be okay if we retire? Will our money last if we retire? 833-707-3030 is the number. No cost to chat with the team. 833-707-3030. 30-30. All right, we're talking taxes today, and it's kind of the tax traps in IRAs and 401ks, if you will. And you're going to continue on the IRA, but you're going to kind of go a little different direction, aren't you, Brian?
Right. So, Mark, let's talk about how IRAs affect Medicare premiums, estate taxes, and beneficiaries.
Yeah. So when we're looking at IRA distributions, taking money out of these pre-tax accounts, 401ks, IRAs, you have to be very careful that you're not taking so much out of these accounts that it triggers some penalties on another factor. One of those factors is it's called the IRMAA, the income related monthly adjustment amount as it relates to Medicare. So Medicare has certain brackets, just like your tax bracket. If you have income above certain amounts, it's going to increase your Medicare premiums. So say, for example, a single filer in 2025, if he has modified adjusted gross income before the standard deduction. So this is before you take any standard deduction or itemized deduction. If your modified adjusted gross income is above $106,000, it increases your annual Medicare premiums and your monthly Medicare premiums. You go from about $185 a month in Medicare premiums up to $259 a month. So if you're not planning around that, you could get a pretty big Medicare premium hit that you're not planning for because you're not thinking about IRMAA limits. So when we're looking at Roth conversions or IRA distributions, we always want to take into consideration both your tax bracket, but also your IRMAA brackets. Because if we do a $250,000 Roth conversion, that's going to skyrocket your income. And there's a 2-year look back when it comes to Medicare premiums. So you'd be paying the penalty of a huge Roth conversion for 2 years. So you have to think, okay, what's the benefit of doing the Roth conversion and what's the cost of doing the Roth conversion? And does that fit inside your monthly budget? And does that fit in your overall income plan?
And we also, Mark, want to make sure that we are attentive to the new OBBB bill, the one big beautiful bill that was just signed into law, because now there are tax credits assigned to 65 years and older seniors where they have the $6,000 credit and the $2,000 credit that's phased out between 150,000 joint to 250,000 joint filers. So we want to make sure that Roth conversions are going to be so important that it negates that credit for that year.
That's right. We have a window of opportunity, 2026, 2027, 2028, that we know this $6,000 per person credit is allowed for clients over 65. So we really want to take advantage of this in our planning and development strategies to say, how do we maximize this as part of our overall strategy as it relates to Roth conversions and portfolio income and gifting strategies and all of the different strategies that we have available to us. Capital gains realization, this might be a really good opportunity to realize some capital gains in your non-retirement accounts. So this opens up a window of opportunity for us as planners. But again, you have to have a planner. You have to have a plan in order to implement these strategies. You can't just go whole hog into these without putting the numbers to paper first.
Good. And Mark, let's talk about real life examples of what we've seen with people as we've done these Roth conversions, how they benefit, how accounts, instead of growing where a third of the money is for the government and growing the government's portion, how we proactively pay taxes now so that if tax rates go up, and by the way, there's 37 trillion reasons why they probably will go up, but if tax rates go up, our clients are even better off because in addition just to the growth of tax-free growth, we also have the benefit of proactively paying taxes now before rates go higher. But Mark, give a a real life example or any recent example of a client that made these changes?
Well, I was just talking to a client and he had 2 IRA accounts. One IRA account was invested in one strategy, another IRA account invested in another strategy. Both of them, performance-wise, did pretty good. They both got about 15% growth rate in the account over the last 12 months. One of them was an IRA and one of them was a Roth IRA. And I asked the client, I said, would you rather have this money growing at 15% tax-free, or would you rather have that money growing at 15% income taxable? Well, obviously, you want it growing tax-free because the tax equivalent growth rate would have to be about 19.2% growth to give him the same benefit that a 15% growth rate in a Roth gave him. So if I'm explaining that well, the tax inefficiency of the pre-tax account requires a higher growth rate in order to make up for the taxes that will be owed in the future.
Good. Okay, well, let's talk about other tax benefits when it comes to the 401k. Before people roll their 401ks into an IRA, there is a couple of things that they want to make sure that they know about. Talk about, to our radio listeners, the net unrealized appreciation option.
So for some clients here locally, we have a number of clients whose companies are publicly traded on the S&P 500 or on the NASDAQ. So you're looking at companies like Microsoft, Google, Apple, Amazon, Boeing. If you work at a company that offers the option for employees to purchase your company stock inside of your account, let's say you work at Boeing for 20 years, and while you're working there, you're acquiring Boeing stock inside of your 401k, taking advantage of the stock price reduction that you're able to get inside the account. Well, now fast forward 20 years and maybe you have $300,000 or $400,000 of Boeing stock inside your 401k, and maybe you have a very low basis in that stock. So what you paid for the stock is very low, and what your stock value is worth is very high. There are some tax strategies that you can implement in order to roll those stocks out of your pre-tax account into a non-retirement account and avoid paying income tax on those distributions. So your income tax rate on that distribution would be somewhere in the neighborhood of 22, 24, 33% taxes. But if you roll the company stock out as a single lump sum distribution, you can receive a long-term capital gains tax rate on those positions instead of income tax. And you're talking about a reduction in tax rates down to about 15% rather than 22, 24, 33% taxes. So the tax savings opportunity is really significant when you're talking about company stock inside your 401k, and working with a financial advisor, you can have that analysis done. You can review that strategy and see if it's beneficial in your situation.
Mark, what if I've got a year where I exercise stock options and spike my income? Is there a strategy that can be helpful as an offset that year?
Yeah, so that's a great softball, Brian. You teed it up exactly right. And the donor advised fund is one strategy of a few different strategies out there that clients have available to them, where they're able to take a chunk of money. Let's say it's a high commission year, or you get a large stock option that pays out to you this year and it spikes your income. So you're used to seeing annual income of $200,000 or $250,000, and then all of a sudden an extra $100,000 or $150,000 comes into you as taxable income for the year. And it just, then all of a sudden your tax planning strategies go out the window because this is going to be taxable to you as income. Well, the donor advised fund is a great option for clients that are already charitably inclined, that already itemize their taxes. It gives them the opportunity to make a one-time contribution to a charitable account that is a future gift to charities. But in the year that you make the contribution, you're able to significantly reduce your income tax burden for the year. So as a comprehensive strategy, this is very powerful. And for clients who have large IRAs and their annual distributions from the IRA accounts are going to be very large, wrapping a donor advised fund strategy into your distributions is really important. So this is definitely something that we want to consider. We want to have this conversation with clients as a means of tax control, but also charitable giving.
833-707-3030. If you'd like to have this conversation with the team at Decker Retirement Planning, Brian J. and Marc Knauss, that's certainly an opportunity for you, and it's one that I don't know why you would pass it up. There is no cost for this. There is no obligation. There is no pressure. But you think about the next 20, 30 years of your life, if you're that age, right? And you have the opportunity to put yourself in a better tax position down the road. Why would you not take advantage of having this opportunity to chat with the team? 833-707-3030. No cost to you whatsoever. 833-707-3030. Halfway through today's Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning. Back with more right after this.
Your story is unique, and so is the legacy you leave behind. Connect with Brian Decker at 833-707-3030 to start writing the chapters of your legacy and ensure it reflects your values and dreams.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning. I'm Mark Elliott. Again, the website to learn more under the heading of Safer Retirement Education. You got Brian's book on retirement, the Decker Approach book. 12 different things you can download. It's all there for your information. Download it all if you'd like. And then if you have questions, call Brian and the team, 833-707-3030, 833-707-3030. I'm Mark Elliott. Glad you're with us today. All right, Brian, you guys have covered a lot of ground on IRAs and taxes and all that. You're staying in that world, I'm sure, but where are you going now?
Mark, let's talk about IRAs and how they affect estate taxes and beneficiaries.
Yeah, this is really powerful, especially here in Washington State. I want to just kind of quickly conceptualize what this looks like for Washington State citizens here. Starting next year, the estate tax threshold is going up to $3 million per person, and any amounts above that is going to be subject to pretty large capital gains tax rates. You're looking at about 14 up to 30% taxes owed on any amounts over $3 million. So from a financial advisor perspective, the dollars that are being passed on to the next generation, we want those to be the most powerful dollars possible. Most likely, that's going to be the house. That's going to be the bank accounts. That's going to be assets owned by the living revocable trust. But it will also likely include retirement accounts. So if you're looking at a pre-tax account, say an IRA or a 401k, these accounts now count towards the calculation of estate taxes. So you're running up against that $3 million threshold, but they also are income taxable. So the IRA is taxed at two different rates. Number one, it's taxed at income taxes and estate taxes. So it's just one more reason why doing the Roth conversion makes so much sense. Let's say you've got the $1 million IRA, you do a Roth conversion, and maybe you withhold 20% of that Roth conversion in taxes. So now your Roth, which is tax-free money, is not worth $1 million. Now it's reduced down to $800,000, but that reduces your estate tax exposure. So you've just reduced your estate tax exposure by $200,000 by doing the Roth conversion. That's incredibly powerful. And when your beneficiaries inherit the Roth IRA, that money can grow for 10 years before they have to take the money out. So for 10 years, your beneficiaries are getting the benefit of tax-free growth, tax-free growth, tax-free growth, tax-free growth. And then at the end of the 10th year, they take the whole distribution out because they're required to. But all of that growth has been sheltered inside of the Roth IRA wrapper. Very powerful, both when it comes to an estate planning strategy and a beneficiary strategy to have that money inside of a Roth IRA.
Okay, Mark, and what about the beneficiary part of the IRA?
When, let's say, like my dad has 3 sons. So I'm the middle child. I have an older brother, me, and my younger brother. Let's say we inherit his IRA. So what happens is you take the IRA, you divide it by thirds, a third, a third, a third goes to each one of us. And we are, by law, required to distribute that pre-tax IRA to us as taxable income. Well, here I am, me and my brothers are in our late 40s and 50s. We're in our peak income earning years. And now all of a sudden, over the next 10 years, I have to distribute, let's call it $300,000 to me as taxable income. So that's about $30,000 a year in taxable income that I have to pay on while I'm in my peak income earning years. So I'm already in my 24% tax bracket, and now I have another $30,000 that I have to take as taxable income on top of that. It's just very tax inefficient. If those were Roth dollars, it would be such a blessing to inherit tax-free dollars that don't push me into a higher tax bracket on the distribution side.
Okay. Well, Mark, let's talk about other tax strategies now that are helpful for our radio listeners. We talked about the donor advised fund. What if someone has huge capital gains on their real estate or their stocks? Are there options there?
We are running into this more and more often as we've seen companies like Microsoft, NVIDIA, Google, Apple, Amazon, Boeing, all of these companies have gone up in value over the years. And I'm talking with clients that have significant capital gains exposure. They've got $3 million in Microsoft stock, and they don't want to sell the stock necessarily because they know that when they pass away, their children will get a step up in basis. So all of that capital gain gets erased when a spouse dies. So when the first spouse dies, the children or the surviving spouse receives those assets with a step up in basis. But there are a few different strategies you can look to either minimize the capital gains today, or you can continue to hold on to that asset and use it to generate income to you through covered call writing strategies. So if a client wants to write call options on their individual stock position, you can generate 4, 6, 8, 10% a year in income on that strategy. You can use a strategy called a charitable remainder trust that allows you to generate income to you for the rest of your life using that asset. So you move the asset inside of the trust. You can sell it once it's inside this trust and avoid the capital gains associated with the sale. Or there's another strategy out there. You don't hear a lot of people talking about this, but it's called upgifting. So with an upgift strategy or an upstream gifting strategy, you're gifting the stock or the highly appreciated asset to an elder parent. So let's say you have a parent who's in their 80s or 90s. When you gift that stock to them, you're moving it out of your estate, but they can receive that stock or that property or that asset, and they hold on to it, and then they can name you as the beneficiary on that asset. So when they do pass away, you inherit it back, and there's no capital gains incurred because you receive the step up in basis upon their passing. So there's a number of strategies out there. Each one is a little bit different. There's some nuance in how these strategies work, but it's very important that you talk with somebody who understands the tax implications of your portfolio and how best to optimize these in a comprehensive plan.
Mark, what about when you've married someone 10 years younger, you retire, you're 65, your spouse is 55. Speaking of the Roth conversion, is there a plan there to take advantage of something?
Yeah, this is a really unique situation where we run into this every once in a while, where an older partner has a large asset and their younger partner, say 10 years younger than them, has a longer runway until they're subject to required minimum distributions, or they're still working and contributing to their portfolio. You can utilize a strategy called a qualified domestic relation order. This is essentially a legal divorce proceeding. We call it the happy divorce, right? There's sad divorces that happen, and this is where a relationship terminates. But this is a happy divorce where the relationship continues, but on paper, the divorce is issued by the court, and that divorce issuance goes to the 401k administrator, and it instructs the administrator to separate the value of the 401k into the older client's portfolio and the younger client's portfolio. And that allows the younger client to receive those funds and do the Roth conversions with a much longer runway for long-term growth before being subject to required minimum distributions down the road.
Mark, we won't get through all of this in this segment, but the state of Washington has a state income tax. There's 27 states that don't have one. There's 23 states that do. State of Washington is one. California and Utah don't have a state tax, but the state of Washington does. Are there strategies that help you avoid or minimize that estate tax in Washington?
Right. So I mentioned, starting next year, 2026, the estate tax threshold goes up to $3 million. But we work with a number of clients who are well above that. And so the annual gifting limit really is just a drop in the bucket. It doesn't really move the needle all that much. The easiest solution is to move out of Washington state. If you say, all right, well, Washington state has the estate tax threshold, but there are so many other states that don't. So maybe part of the conversation around estate tax minimization is that moving your primary residence outside of Washington state is something to consider. But when you do that, it doesn't mean that you have to move out of the state completely. You just have to have your primary residence be in another state. It doesn't mean you can never come back. So when you're talking about changing your state of residence, you need to prove to Washington State that you are no longer a citizen of this state. Usually that means something like updating your driver's license or getting a library card in a new state. If you were to purchase, let's say, a vacation home in Florida, for example, you change your primary residence, where you consider to be your home is now in Florida, and you come back up to Washington State to visit. So that's something that is a very common strategy for people who are ultra high net worth and subject to estate taxes, in addition to gifting strategies and charitable giving and estate tax minimization and Roth conversions. Also identifying states that are not subject to estate taxes becomes a very important part of the discussion.
So again, if you'd like to have a conversation with the team at Decker Retirement Planning, Brian J. Decker, Marc Knauss, the team, just give them a call, 833-707-3030. And not everything they talk about every week on this program pertains to you, but there's probably some areas you're like, wow, I didn't know that. I'd like to know more. How does that really affect us? 833-707-3030, no cost to you. 15, 20, 30-minute phone call, just have a conversation. Then you see where it goes from there. 833-707-3030. Back with our final segment of today's Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning, right after this.
Uncertainty in the markets doesn't have to mean uncertainty in your financial future. With the right approach, volatility can be an opportunity. Let Brian Decker and the team at Decker Retirement Planning help you navigate market changes. Call 833-707-3030 today.
Do you want your retirement to be affected by who was in the White House? I didn't think so, but here's the thing. No matter who wins this time, they'll only be in the Oval Office for 4 years. But how long will your retirement last? Presidents can have a huge impact on taxes and the economy, but there is another presidential election in 4 years, then another, and of course another. Brian Decker at Decker Retirement Planning can help you create a customized plan that's really as White House proof as possible. Schedule your visit with Brian Decker today by calling 833-707-3030. Brian doesn't know who will win in November, but he can help you prepare for it, no matter what happens. Reach out to Brian Decker to get started. Call 833-707-3030. Don't let who's in the White House affect your retirement. Call 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio. I'm Mark Elliott here with Brian J. Decker and Marc Knauss of Decker Retirement Planning. Again, you can go to the website to learn more, DeckerRetirementPlanning.com. There is the heading of Safer Retirement Education. There's 12 things you can download. Brian's book on retirement, The 3 Principles of Retirement book, a checklist challenge, a sample income plan, or just 4 of the 12 things you can download. It's all there for your information. If you get any or all, and then you got some questions, or you just have some questions right now thinking about, boy, I think we've done the right things. I think we should be able to retire and be okay, but you don't know, call the team. That's what they're here for. 833-707-3030, 833-707-3030. All right, final segment, Brian. Where are you and Mark going?
Okay, well, let's keep going down the tax side. When it comes to this is one of my favorite, Mark, and you just had this last week. If you have a rental income stream, can you really make it tax-free?
This is really an interesting question. You run into this a lot around here, the Pacific Northwest. I have talked to so many clients that have made their wealth in investment real estate. And you get to the point where this income that's coming to you from your rental property gets to be very significant. And the taxes associated with that rental income drive you into a higher tax bracket. So now all of a sudden you have Social Security coming to you, you have your IRA distributions and portfolio income coming to you, and you also have rental income coming to you. Well, what strategies are out there that are available to investors that can reduce the income taxes associated with rentals? When you buy investment property, there's something called a depreciation schedule. So take, for example, you buy a rental property. The government allows you to depreciate that property over 27 and a half years. So a little bit every year you're able to depreciate, and you can take that depreciation and use it to offset your taxable income. Well, that's nice, but 27 and a half years, you're really not getting a whole lot of depreciation credits to offset your income. So there's a few different strategies you can consider when looking at this. One of them is something called a cost segregation strategy. So a cost segregation strategy, what you do is you hire a firm. Usually it's about $2,500 or a few $1,000s to come in and do an analysis of your investment property. So they look at the carpets, they look at the walls, they look at the countertops, they look at the brick fireplace, they look at the roof, they look at the deck, they look at the windows, every component of the house, and they give each one of those components a line item depreciation schedule. So instead of depreciating the entire house over 27 and a half years, now you're able to accelerate the depreciation schedule down to about 10 years. So you get much larger depreciation amounts every year because of the accelerated depreciation schedule. But here's where you got to watch out. After 10 years, or when that depreciation schedule runs out, now all of a sudden you have this tidal wave of taxable income coming to you that you no longer have depreciation that you can use to offset that. So that's why investors are frequently doing what's called a 1031 exchange. So a 1031 exchange allows you to sell your property and move the value of that property into a new investment property and defer the taxes. So you don't have to pay the deferred depreciation. You don't have to pay the capital gains associated with the investment property. You're pushing all of those. You're kicking the can down the road. So once you do the 1031 exchange into a new property, then you do another cost segregation study on that property, and it allows you to start the process over again with a new property, most likely a bigger one. If you're deferring the growth and now you're selling that and moving into a larger property, now you've got the same income coming in or more income coming in, and it's also tax-free. So a very powerful tax saving strategy. And if you look at the tax benefits in the OBBB that just made its way through Congress, the one big beautiful bill, you'll notice that there is a 100% depreciation allowance for rental properties. And you can actually blend the 100% depreciation allowance with a cost segregation depreciation. So you can really target your depreciation schedule both between a large lump sum depreciation in year one and smooth it out over the next 5 to 10 years with a cost segregation study.
And that creates an income stream on your rental real estate properties that is tax-free with accelerated depreciation. Okay, that's one of my favorites. Mark, I'm going to take this one. This is a dynasty trust. This is where you've got your 2 or 3 children that say, Mom, Dad, we're doing great. We don't need any help. Go ahead. Any money you've got, you spend it. And you think, geez, what about the grandkids? Well, if you want to send your money down to the grandkids, you're subjecting yourself to a generation skipping tax of 48%. And the reason is because you're preventing a whole generation of taxation on those funds. So the IRS hits it pretty hard. But there's a generation skipping trust called a dynasty trust where you can create the trust while you're alive. And let's say you've got 3 children, you can have the dynasty trust created while you're alive and listed as a beneficiary so that when you pass away, the dynasty trust can take a portion of your estate and you, on a blank chalkboard, you list how you want that trust to distribute. You distribute based on whatever is important to you. Here's what's typical. So now this dynasty trust is perpetual and it's per stirpes. It's bloodline only. So when your children and grandchildren and their children and their children, your legacy, if there's a divorce that stays in your bloodline, these funds cannot be split out to another person. It stays in their bloodline. And then what you incent is responsible behavior as you see it. So typically a percentage of the trust goes to your grandchildren or their children if they go to college, in their first marriage, down payment on a first house, so that if they don't go to college and they don't marry and don't buy a house, they don't get any of the trust. So you're able to incent the behaviors that you feel are responsible behaviors. That's called a dynasty trust. That's something that we help clients put together, especially when their children are doing financially very, very well. It allows you to cross a generation, not be hit by that 48% tax, and benefit your legacy. Mark, we've got a couple more minutes. Let's hit the GRAT.
Sure. So this is a strategy for ultra high net worth clients. At the federal level, every American is allowed $13 million in gift or estate tax, estate value over their lifetime. But there are a number of clients who worry that their lifetime exemption is going to be over that amount. And in order to avoid being over that amount, you can utilize a trust structure that allows you to structure a loan between a trust rather than a gift to a trust. So let's say, for example, I have $15 million in my portfolio between real estate, my portfolio, my primary residence, and I want to move some of that out of my estate, but I don't want to use my lifetime gift exemption. Well, I can structure a loan between a grantor retained annuity trust and myself, where I transfer assets to this trust and it pays me income as a loan payment every year for the rest of my life, while allowing me to move this large asset. Let's say I've got a $4 million property. I can move that property outside of my estate, and the trust pays me a loan payment every year for the rest of my life until I pass away. So that's a very powerful tax planning strategy to move assets outside of your estate without taking up your lifetime exemption. Another very common strategy out there, and I see this more and more often, is utilizing an irrevocable trust. So an irrevocable trust is a trust that is outside of your control, but still for your benefit. For clients who are going to be over the Washington state estate tax threshold, they can utilize an irrevocable trust and purchase a life insurance policy inside of it. Why would you do that? So essentially, it's a wealth replacement strategy. When husband and wife pass away, the life insurance policy pays out to this irrevocable trust, and it creates a cash infusion for the beneficiaries that they can use to pay estate taxes, to pay capital gains taxes, to pay any foreseen expenses that might be coming up down the road, without forcing the children to fire sale family assets. You don't have to sell the vacation home. You don't have to sell the investment property. You don't have to sell the primary home in order to come up with the cash needed to cover expenses related to passing. So that's called an irrevocable life insurance trust. It's very common for clients who have significant wealth and want to find ways to prepare for estate taxes down the road.
As always, on Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning, and today with Marc Knauss. A lot of ground covered. Any questions you have, you would like to learn more, about anything they were talking about or something that else is concerning you about upcoming retirement, or you're retired already and you have some concerns. 833-707-3030 is the number. Again, no cost to you. 833-707-3030. Might be the most important phone call you make. No cost to you. 833-707-3030. Brian, Mark, appreciate the time. Enjoy the rest of the weekend.
Thanks, Mark.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.